guys, welcome to my channel Investing Untangled. Hope you're all doing well. On this channel I post videos about stock market research and also educational videos about stock market investing and detailed business and stock analysis. And if this is something that interests you, then hit the subscribe button and follow my content here. Today I'll talk about Alibaba. Alibaba has been in news for quite some time, and in this video I'll analyze their business and I'll tell you what kind of opportunity, the growth opportunity that they have in future, and why is this stock crashing and why is the stock price kind of depressed. So we'll talk about risks versus rewards in this video. So one of the major reasons why this company has a very strong growth potential going forward is because e-commerce is on the rise. And if you see the 10 largest e-commerce markets in the world, China is by far number one. And here you see the annual growth rate of Chinese e-commerce market is 35%, which is very, very high, the highest in the world. And it's not only China, it's Southeast Asia and East Asia. All these countries are growing very fast there, and internet penetrance is growing very fast there. And China actually has the highest number of internet users in the world. So this pushes all this e-commerce growth there, and Alibaba is actually the number one player in this sector. Now, looking at their business model, Alibaba is a big data-centric conglomerate which has actually diversified its revenue streams into multiple different directions. It is the biggest e-commerce giant in China and one of the biggest in the world. And e-commerce companies are judged by gross merchandise volume, which is basically the dollar amount of the stuff that was sold on these platforms. And here you can see GMV per active user for Alibaba was 730 in Chinese currency in 2019, and this was much higher than the competitors Pinduoduo and JD.com. And by the way, GMV, gross merchandise volume of Alibaba, is even higher than Amazon. So this shows you the scale at which this company operates. This is a giant company. Morningstar also gives a categorization of wide economic moat to this company. It has a very strong wide network moat. And analysts here think that it is at a 25% discount, and the fair value for Alibaba is $303. And at the time of recording this video, Alibaba was trading at $226. Now let's look at some vital numbers, the historical numbers for Alibaba, and all these numbers are in Chinese currency CNY. So revenues have gone up from 6.4 billion to 509 billion in 2020. Net income has gone from 1.7 billion in 2011 to 149 billion in 2020. The company has been buying back its shares from 5 billion shares outstanding in 2011. In 2020, the shares outstanding were 2.6 billion, which is good for shareholders. Operating cash flows have also increased from 2.1 billion to 180 billion in 2020. And free cash flows have gone from 2 billion to 135 billion. Book value per share has also increased massively. This one is in US dollars, from 8.85 USD per share to $38 per share in 2020. So a staggering growth all across these years. Net margins for this company are very, very good, over 25% most of the times. Returns on equity and return on invested capital are extremely good. This shows that the management is doing a great job at getting great returns. And financially, the company is in an extremely solid condition with a current ratio of 1.91 in 2020 and a debt to equity ratio of 0.18. So financially, this company is very solid, and all these numbers show that this company has grown very, very fast in all these years. Now let's look at some recent numbers. Revenue growth has been staggering, still at 37% year over year. And what is really nice for this company is the growth in their cloud business. So they're expanding very, very quickly, and this company has already become one of the biggest in the world in this space. So they registered a 50% year over year growth on cloud computing revenues, and they're already positive on adjusted EBITDA. They actually grew faster than Amazon and Microsoft in the cloud space. So Alibaba registered a faster growth than Amazon and Microsoft. And this makes them actually one of the biggest cloud providers in the world. So they're only behind Amazon Web Services, Microsoft's Azure, and Google Cloud. So cloud space together with e-commerce will be actually the major revenue drivers going forward for Alibaba. Now, if this company is doing so well and it has done so well in the past, what is the reason that its stock has been crashing? And now we'll discuss those things, and then we'll discuss a risk versus reward situation here. So one of the first things that crashed the stock late last year was when Chinese government actually blocked the IPO of Ant Group. Ant Group was the financial affiliate of Alibaba, and Alibaba owns 33% equity stake in this Ant Group. Jack Ma, who is the founder of Alibaba, criticized openly the banking system of China, and that led to a backlash and led to finally the suspension of the IPO. So this was one of the first things that crashed the stock. Since then, they've also ended up in an antitrust investigation by the market regulator of China. And recently this news came out where China told Alibaba to sell off media assets in tech crackdown. So this is not set in stone yet. This is still being negotiated, and Alibaba is actually completely complying with this investigation, and so this is not certain yet. But this was another big negative news that crashed this stock very recently. Let's consider the worst case scenario for Alibaba here, and maybe Alibaba has to sell off the media assets that it owns. Let's see a revenue breakdown of Alibaba here. So here is the digital media and entertainment, which is just 4% of Alibaba's revenue. And as I told you, major revenue growth going forward will be through e-commerce, which right now is their biggest revenue generator, and cloud is growing very fast for them. Right now it earns 7% revenue for them, and going forward it will actually increase its chunk in the overall revenue for Alibaba. So even if Alibaba has to actually sell off its digital media and entertainment portion, assuming the worst, it still will be totally fine, because this will not be the major driver of its revenue going forward. So recently also this news came out where it was thought that China is basically cracking down on all these big tech companies like Tencent, Baidu, Alibaba in these antitrust investigations. And here it says separately, the watchdog is reportedly weighing a record fine of more than 975 million on Alibaba, according to the Wall Street Journal, but these reports have actually been denied by Beijing. So it is not confirmed yet, but there were reports that Alibaba might be fined for $975 million. Now let's again assume the worst kind of situation in this case here, in these antitrust investigation situations here. SAMR is the Chinese market regulator, and as per Chinese law, they can fine Alibaba up to 10% of prior year's sales of the company. So in that case, Alibaba will have to pay a fine of 5.8 billion US dollars. And here I'm again assuming the worst case scenario. So this is a really worst case scenario, and in that case, Alibaba would end up with a fine of $5.8 billion. Which is a lot, but if you think about this way, Alibaba's free cash flow for 2020 was around $20 billion. So $5.8 billion, which is quite a lot of money, but for a company that operates at a scale and profitability of Alibaba, it's actually not a huge lot. So here again, assuming the worst, Alibaba will still be fine even if they have to pay this highest fine of $5.8 billion, and even if they have to divest all these media operations that they have. Another major fear that investors have about Chinese companies in general is that there is a threat that they might get delisted from the US stock exchanges. But here you can see how heavily these Chinese companies have been invested in. Chinese companies listed on US exchanges have a combined market cap of about $2.2 trillion. So a mass listing would mean major movements of capital, something that experts say could backfire on American investors. So if these giant companies like Alibaba are delisted from US stock exchanges, there will be quite a big shakeup in the investment industry in America, because billions of dollars of hedge fund money and mutual fund money is actually invested in companies like Alibaba. So in that sense also, I think, in my opinion, delisting big giant companies like Alibaba is not really on the cards. These companies will actually comply with all the regulations that American law is forcing upon them, and there will be sort of a middle ground situation that will be accepted. So in my opinion, all these headwinds are basically buying opportunity for a company like Alibaba, which is a great business and it is clearly on sale right now. And if you look at super investors on Data Roma, you see in Q4 of 2020, when all these investigations had already started, a lot of super investors actually started buying heavily and started adding to their Alibaba position. Here you can see all the activity that has been done in 2020, and in Q4 of 2020 all these super investors actually invested in Alibaba. Now let's calculate the intrinsic value of Alibaba. I told you Morningstar gave it a fair value and intrinsic value of $303. Let me calculate it myself for you here. Morningstar says Alibaba will have a compounded annual growth rate of 22% in its revenues going forward from 2021 to 2025. Yahoo Finance estimates a 30% revenue growth in 2022. And let's be conservative and let's pick up 20%. Which I think is very reasonable given the cloud growth they have going forward and also the growth in their e-commerce sector. So I'll run you through this calculation, and if you're not familiar with intrinsic value and this calculator, I have done a previous video that I'm linking in the description for you to check out. So these are all numbers in the Chinese currency CNY. And these are here the free cash flows. The most recent ones will assume a 20% annual growth rate going forward. We'll do the calculation for 5 years and the discount rate will be 10%. I generally use a discount rate of 10%, which I think is reasonable. You can pick up whatever you like, whatever rate of return you like. And the perpetual growth rate will be 3%, meaning after 5 years, we assume that Alibaba will be growing at a 3% compounded annual growth rate. It has 2.7 billion shares outstanding right now. And with all this information, I came up with an intrinsic value of 1878 CNY. So this is not dollars, this is Chinese money. And if you convert it into US dollars, it amounts to $285. So similar to Morningstar, my calculation also reveals that Alibaba is right now undervalued. And if you look at Guru Focus, here also analysts think that it is significantly undervalued, and they assign an intrinsic value of $344. I personally do own some shares of Alibaba, and I have actually been buying some more in this recent dip because I believe that this is actually a buying opportunity, and all these problems right now that Alibaba is facing are temporary in nature, and going forward this company will keep compounding. Let me know in the comments below what you think about Alibaba and if you are interested in buying this company at these prices, and I'll follow up with you on that. If this video was informative for you, please consider leaving a like and subscribe to this channel, Investing Untangled. In future, I'll be posting more videos about new opportunities for investing in the stock market, and I'll also be posting videos about detailed stock analysis. So that is pretty much all for this video. I'll see you in my next one.